To start, you coined the term vibesession in a 2022 Substack post that captured the economic zeitgeist of the time. The term has appeared in Fed speeches, on cable news. When did you first hear someone use that term and not know that it came from you?
So the vibesession was created, I think, during a very different economy. So it's this idea of the disconnect between data and sentiment. So it was created during the Biden economy, where we were coming out of the pandemic, inflation was going down, the labor market was recovering, the economy was growing, but people felt really, really bad. And so that was something that was very interesting. It's like, well, why are people feeling so bad if the economic data is saying that everything is going in the right direction? And so I wrote this Substack post kind of talking about that, and then it turned into a New York Times opinion piece. And it's sort of evolved since then. Scott Bessent, the current Treasury Secretary, talked about it. I don't think
it's in his stump speech when he talks about the Biden economy.
I don't think he knows that I created it. It's beyond me at this point, and it's been interesting. You know, Jared Bernstein, who was the chair of Biden's Council of Economic Advisors, has done a lot of amazing research on the term and sort of understanding. You know, sentiment just hit an all-time low. So really, why is this disconnect happening? But it's definitely had a life beyond me at this point. Yeah.
I want to talk about the economy as it is now, but first, I want to talk a little bit about you. I mean, I'm a working journalist. I've watched your work. I'm fascinated by how you found ways to reach a younger and a growing audience. So you went from selling cars in college, producing very high quality TikTok videos that explain and digest the economy really well. You wrote a book, In This Economy, How Money and Markets Really Work. How did you end up carving this career out for yourself?
Yeah, so I grew up in Louisville, Kentucky, and one of my jobs during college when I was at Western Kentucky University was to sell Hyundais on Shelbyville Road in Louisville, Kentucky, if anybody's ever been to Louisville. And it was a really eye-opening experience for me because I was studying economics at the time, and people would come into the car dealership, and it's a very intimate experience, you know, buying a car from someone. You have to share your credit score. You have to talk about what you need the car for. You have to talk about your family situation. Like, you really do get a lot of insight into somebody's financial health. And so there were all of these people coming into the car dealership, and I was 19 years old, and I ended up sort of counseling people on their economic health, being like, no, you really maybe shouldn't buy this car. I don't think it's good for you. Or you should think about this car. It's a little bit cheaper, and here's how you can rebuild your credit at the same time. So it ended up being this financial counseling path, which was really enjoyable. So when I graduated in 2019, and I thought I was going to go work on the buy side and be a portfolio manager and just have this path. And then the pandemic happened, like right after I graduated. And I realized that I wanted to go back into economics education and go back to, you know, helping people that were coming onto the car lot and helping them understand their economic health. So I wrote the book, In This Economy, which is used as a textbook in some classrooms. And that's been the journey. Is we talk about the economy in terms of averages, but it is such a personal experience. And so it's really important to sort of meet people where they're at, especially during a time like right now where it's so uncertain. So that's been the windy path to get on the stage, yeah.
No, that's great. So give me your elevator pitch today for the economy. Imagine I was in space. I've come back after a year in space. I haven't been following any of the news. How is the U.S. economy doing?
Yeah, I mean, I know that you're in space, but your reporting has really helped me understand the economy. You do such an incredible job explaining the Fed. It's so phenomenal. But I think the way that most people would describe the current economy is uncertainty. You can really see that again in consumer sentiment being at a record low. A lot of people don't feel good about their financial situation. There's a lot of issues with structural affordability, so the housing market is pretty inaccessible. You have a lot of people getting squeezed on either end with childcare costs and elder care costs, which are becoming pretty untenable for a lot of people. There's uncertainty about technology. You know, is AI going to take all the jobs? Is it not? Nobody really has a clear answer either way. And then you have sort of the political uncertainty too, you know, the geopolitical conflicts that keep arising. And so I think a lot of people are just trying to find solid footing within the economy, but it's changing so quickly. Things are getting more expensive. The labor market is becoming more uncertain. Most of the jobs that we're adding are in healthcare, and a lot of people aren't trained in that field specifically. Economic growth is happening, but it's primarily driven by the technology build out, as we saw in GDP metrics that came out last week. So I think it is really this feeling of general uncertainty. And I'm sure it's the same for you. Like when you sit down with anybody and talk about how they're feeling about the economy, you don't hear a lot of people say, I feel great. And that's something to really keep an eye on.
That's a great point. In the last 5 years, in talking to economic policymakers, whether the Fed or other places, they'll say things like, we haven't seen this in 40 years or in ever, whether it's the pandemic, the inflation, and now this idea that maybe the economy doesn't have to add any jobs to keep the unemployment rate from going up because the break-even level of unemployment's lower. You wrote in January about the great entertainment, that we're governing the country like a reality TV show. The market keeps shrugging off chaos that might have done some real damage 10 years ago. Is the market the smartest player in your essay or the dumbest?
Well, it's interesting because when you ask who the market is, like what drives the market, that's also not clear. Like who is actually driving the market decisions? Is it the high frequency trading? Is it fundamentals? That's also not very clear. But I think what's been really astonishing about the stock market is its unrelenting path up. It just nonstop going up all of the time, despite all of this uncertainty. And so Greg Ip at the Wall Street Journal wrote a great piece talking about how corporate profits keep on expanding while labor income does not. And so I think that's sort of a key driver there, is the stock market goes up even if people aren't feeling good, and that is the disconnect. The stock market is not the economy. And it seems like the stock market, too, is, in my opinion, really reliant on this idea of a rescue mechanism. Like every time something has gone wrong, the stock market has been saved. Greenspan saved it, Bernanke saved it, Powell saved it during the pandemic, and it was something that the Federal Reserve had to do during that time to provide a floor. But I think the market just expects that, and rightly so. It seems very rational that it would be saved, but I think it prevents it from pricing in risk properly because there is that expectation of rescue.
So Warren Buffett said over the weekend that in his 60 years of business, we've, quote, never had people in a more gambling mood than now. And he specifically criticized the surge in one-day option trading, saying that's not investing, it's not speculating, it's gambling, just totally. Do you agree, disagree? What's the worry here? Do you share his worry?
I do worry a lot about gambling. There's a statistic out that over half of 16-year-old boys have bet on prediction markets, and I don't think that's great. Like, I think that we should be insulating people from the effects of, I consider prediction markets gambling, and I think that we should insulate people a bit more, but there is a very hands-off regulatory approach to insulating people from prediction markets, insulating them from sports gambling. And both Bloomberg and the Wall Street Journal had pieces that came out over the last week talking about how much money people are losing on the prediction markets. I think it's like 70% of people who use the prediction markets end up losing money, and the people who make the money are, the people who are sharps. They're paying attention to stuff that, insider trading, things like that. So I don't know if that is necessarily the investment environment that we want to encourage people to participate in. And I think Warren Buffett is obviously the expert on that. Like if he's pointing out that there's a problem with options trading, with prediction markets, with sports betting, it's something to really pay attention to. But I think we have this very short-term mindset approach to wealth generation right now, where young people feel like they have to go and gamble on the prediction markets to make the bag, to make a bunch of money right away, because they don't have a lot of trust in their long-term future. So we see that data-wise in things like the Harvard Youth Opinion Poll, which came out in April 2026, and young people don't trust in institutions, they don't really trust in each other, they don't trust in the government, and so of course they're going to look towards short-term investments in an attempt to make a lot of money because they don't trust in the long-term future of the institution. So I definitely agree with Warren Buffett that gambling is a big problem, but I think it's rational that people are doing it.
So you point out the erosion of trust in society, which it seems like this is a path you can get on that actually has a negative feedback loop. Another innovation in financial markets has been private credit. It's gone from a backwater to a multi-trillion-dollar market in a decade with insurers now as major holders. You write a lot about Minsky moments. Is this a Minsky setup, or is this just rational diversification?
So I am a senior fellow at the Vanderbilt Policy Accelerator, and we just had a big paper come out on insurance and the interaction of private credit and insurance. And I think that the insurance companies are taking on an extraordinary amount of risk with private credit. They also are gambling in an attempt to make a little bit of money. So I do worry that everybody is taking a very risk-off approach. And when you talk to people like the author of the paper, Brian Shearer, he does point out that this is really risky because of the sense of entanglement. So if something goes wrong with private credit, the insurance companies, something goes wrong with them, and it becomes that domino effect like we saw in 2008. So I think it is something that is quite concerning, primarily because it keeps growing. Now there's talk of adding it into 401ks, which is not the best thing, I think, to do in terms of exposing the everyday person to the volatility of private credit. So I do worry about it, and I think that the fact that it keeps spreading into all of these aspects of the economy is really the worrying part.
So if something breaks in private credit, is there a retail person today who gets hurt? Walk us from sort of the abstraction to the kitchen table. Who is the, in 2007, the saying was that subprime was contained, right? There was this thinking that, well, it was only 1 or 2% of the mortgage market. So walk us through, where that adverse scenario leads.
Yeah, so private credit is this idea that banks aren't going to make these risky loans to risky companies, so these other firms are going to step in and make the risky loans to risky companies. So they're fundamentally already pretty risky loans, and right now they're being packaged into retail products for mom and pop investors to purchase. And so we saw this with a company called First Brands, which was an auto lender who exploded. And if you have those sorts of explosions, that took down some, JP Morgan had a lot of exposure there to First Brands. And if you have that explosion at the private credit level with these risky loans, and you have mom and pop investors who are investing in these products, they're going to be affected. And so the way that we retire people in the United States is by themselves. A lot of people don't have pensions. And so people, if their retirement plan gets blown up because these risky loans get blown up, they're not going to have a chance to probably retire. So I think that's the big concern. And then the other separate problem, and this is sort of tangential, is like 43% of people in the United States don't even have a retirement account. So that's one problem in itself. And then also you have this huge risk that's starting to happen in the people that do have retirement accounts. And so we have an aging population in the United States. 1 in 5 Americans is going to be over the age of 65 by 2030. And if they're not able to properly retire, it's going to be a very different economy than the one we have right now. So that's the worry, is that the risky loan blows up, the mom and pop investors are exposed, and then we have this big problem. How do we take care of these people that were supposed to exit the labor market by now?
So as you mentioned, Kyla, you joined something called the Vanderbilt Policy Accelerator in March. What's one policy idea from your work, or maybe from your colleagues' work, that you would want a senator or a presidential candidate to steal?
Yeah. So I'm a synthesizer of their work. So they come up with all the amazing policy ideas, and then I get to talk about them, which is awesome. But there's been 2 really great papers that have come out recently from Vanderbilt. One is called After the AI Crash, that talks about preparing for if the AI bubble does pop. How can we think about that? One idea is a Glass-Steagall for AI, so separating the AI labs from the data center build-out, so making sure that risk isn't entangled. One idea, too, is public data centers, so giving people a stake in the data centers that are getting built around them rather than having it be built out by the private companies. And then in terms of the insurance paper, it gets a little bit convoluted. The whole paper is really great, but the idea is that the insurance companies are essentially making a lot of money off of people, especially in states like California, and there should be a cap on how much money that they can make, and there should be rebates to the public if they make above that cap. So I think those are two really good ideas is, how do you bring the general public more into these products, both in terms of AI and then also in terms of insurance?
Your idea about vibes in the economy, and I think it kind of gets at the nostalgia that we sometimes have for past eras that, we maybe remember them better than they were. So I want to put a puzzle to you, because in 2017, we had the unemployment rate roughly where it is now, 4.5% moving down. We had 2% inflation, a little bit lower, maybe a little bit lower than 3% wage growth, so 1% real wage growth. And people were unhappy enough with that economy where they were ready to elect somebody who said, I'm going to do something completely different. Fast forward to today, unemployment rate's about the same. Inflation's higher, but so is wage growth. 3% inflation, 4% wage growth, so still 1% real income growth. Workers are roughly in the same place, and people are more unhappy and probably more nostalgic for 2018, 2017 than anybody would have thought at that time. So a couple questions there. One, do you think we're going to look back at 2025, 2026 the same way 6 years from now that we do today about the late 2010s?
I hope not. I hope not. I mean, it's quite an economy that we have presently. I mean, obviously, like inflation is, it's going up again, and it's primarily being driven by energy costs, gas prices. I live in LA part-time, and gas prices there are like really, really high. So I think that people will hopefully remember that, but that's been the big puzzle about sentiment over the past couple of years, is that people are nostalgic for a time that fundamentally wasn't like that great. And so we're always looking back to this moment and then painting it better in our head than what it was. So it'll depend, like if the economy does end up improving, like if AI doesn't end up taking all the jobs, if private credit remains stable, maybe we will look back at 2026 as, a time that was really bad and then things ultimately do get better. But I guess if things do get worse, then we'll look back at this time as nostalgic.
One of the big changes, of course, I was oversimplifying a little bit to compare today to 2018, because one reason, of course, people are unhappy today, the housing market's a lot less affordable. Prices went up a bunch, and then interest rates went up after that, and prices really haven't come down. We went through a 20+% increase in the price level after the pandemic. Of course, we used fiscal policy aggressively in 2020 and 2021, and there was this idea, even before the pandemic, that we should run a hot labor market. Mm-hmm. Do you think the experiences of the last few years have given either counter-cyclical fiscal policy or a quote-unquote hot labor market a bad name, that when there's a downturn now, people are going to say, hey, hold on here, let's think twice about overdoing this?
In terms of letting their
stimulus and so forth.
It's like that's been again, sorry to keep repeating it, but that's been the big puzzle with sentiment. It's not clear exactly what economy people want. They're not happy about inflation, obviously. They're not happy about somewhat of a strong labor market. And I think that what worked during the pandemic is we did do all that stimulus, and people were very responsive to that. They seemed to really like it. But I'm not sure. I don't know what the lessons will be. I don't know what economy people want.
Axios wrote something about you recently. It said your readers, young, high-potential professionals, are reading you, and not the Wall Street Journal, to understand tariffs and AI and their jobs. I work at the Wall Street Journal, so what are we not doing that you're doing? There's a serious question there. Is it format? Is it voice? What do you think in this media environment people are looking for as they engage with these difficult challenges, trade-offs, questions about the economy?
I think people read the Wall Street Journal. I read the Wall Street Journal, so I think I don't. That was a very kind
flawed premise of the question. It's very kind of you to challenge that premise.
Yeah, I think it's true, and I think also what a lot of people who are like me, a content creator, they will lean on reporting from places like the Wall Street Journal and pass it off as their own video, which I think is pretty egregious. So I think that's like one part of the problem. But then in terms of using video as a platform, like young people do get their news from social media, for better or for worse. And so the way that I think about what I do, so I post videos across social media on TikTok, YouTube, and Instagram, and I've been doing it for almost 4 years. And I got my start doing skits, pretending to be Jerome Powell. And it was really fun, very different time in the world. But that was, I think, one thing is I was having a lot of fun, and I think for a lot of people, economics can be so scary, and it can be so big, and it can be so intimidating that the fact that I was dressing up in a suit and I had the little purple tie.
It's always a purple tie.
It's always a purple tie. It was like really accessible, and I think that a lot of people really resonated with that. And then now you're sort of just competing with attention spans. And so one thing that people don't always love doing is reading. And so if they have it delivered to them in video format in about 3 minutes, I think it can resonate a bit more. But I'm not sure. It's tough because short form video has done massive harm to society, but it's also enabled this new way of communication. So again, I feel like I'm like towing the line on all these questions and being like, it could be both. But I do think that is something that young people really resonate with, is the video format, for better or for worse.
You're a good two-handed economist in that regard. Now, I want to get to questions from the audience. So think of a question. I'll come to you in a couple minutes. You're working on a second book. Without making you pre-announce it, what's the question you want to answer that your first book didn't?
Yeah, so the first book was much more straightforward. Like, it was about the economic kingdom, I called it. So sort of inflation, the Federal Reserve, the labor market, fiscal policy, how does it all tie together? And so I have this drawing at the beginning of the book that is the economic kingdom and all the different castles.
I love the drawing.
Yeah. Thank you. And all the different castles are interacting. And then with this second book, I really wanted to build on this idea of financial nihilism from Dimitri Kofinas, who runs the podcast Hidden Forces, where people are just sort of checked out of the economy. Like, what sort of economy do they want? So I'm very interested by that question. And I'm also very interested in exploring the economic ladder. So sort of all of these big rungs, like thinking about college, careers, marrying, dating, having children, retiring, all of that's really changing under a couple of forces within the economy, thinking of technology and politics and financialization. So I'm really interested in studying kind of the life path of a person as they move through the economy and charting that. And so that's the attempt of the second book, is exploring that economic ladder and how it's evolving underneath all of the forces that we've been talking about today.
If you had, I know you're not into making big sweeping predictions, but if you had to bet on one thing about the U.S. economy in 2030 that no one is talking about right now, what is it that you think we're not talking about today that we're going to be talking about in 4 or 5 years?
This will be kind of, people do talk about this one, but I've been traveling with the first book for about a year, actually. So I've been gone pretty much every week for about a year. And one thing that we talk about when we talk about consumer sentiment is we also talk about retail spending. People are still spending a lot of money. Like, the consumer is still really resilient. And in my travels over the past year, traveling all across the United States, going to really tiny towns and really big towns, I've been so surprised by the resilience of the American people. I think that we don't often give people enough credit for how they're handling the economy, how they manage to piece it together, whether that be doing gig work or whether that be moving in with their parents, or whether that be going back to school. So I think the resilience of the public is something that it's hard to talk about at scale, but I do wish that we talked about it a bit more, and I think it will be something that continues to surprise us, is how resilient people are. Yeah.
I find the same thing in our coverage. When you write about good economic, just objectively good developments, it could be a jobs report or a GDP report, a lot of the reader emails, how can you say this? Things have gotten a lot more expensive. You see it reflected in the University of Michigan consumer sentiment numbers, which have sort of ceased to be the leading indicator that they used to be about consumer spending, because we went through this structural break on inflation. I want to see if anybody in the audience has a question. Oh, it's in the back here. I think there's a microphone, so wait for the mic.
Well, I agree with your statement. I would like to that you just made a couple of minutes ago about short-term video. Can you elaborate more about the harms of short-term video from the view of a millennial, which is, short-term video is your medium these days. So, and can you also talk about the inability of explaining economics in 3 minutes?
Yeah, yeah. Well, so I'm actually a zillennial, so I'm a Gen Z by name. I'm the oldest one possible, but I think that the harms of short form video are the attention spans. So it does train people to keep scrolling. So it ties together both this idea that information should be condensed down to 3 minutes and that it's possible to get across an entire argument in 3 minutes, but then it also encourages people to keep scrolling. So I think that's the harms, is that people don't have a lot of capacity to hold a very well-developed argument because they're used to things being delivered in this format. Like, I can see the retention on my videos, and people kind of scroll. Maybe it's because my videos are boring, but they scroll after about 30 seconds most of the time. So not even within the 3 minutes do they stay the whole time. So that's one part of it, is that it reduces the capacity, I think, to understand argument. And then it also encourages people just staying on those platforms and continuing to scroll. Yeah.
Question in the front, and then we'll get over here.
I was listening to Scott Galloway recently talk about the ketamine economy to describe, one way of describing kind of the detachment or maybe the disconnect that you're showcasing here between the market, say, driven economy and the rest of everybody else. Do you feel like we're set up for a reckoning at all with the election cycle coming up in the back half of the year, or do how do you see that? Will we see those things reconciled?
Yeah. So I guess in terms of the ketamine economy, are you talking more about the numbing effect? Or
Yeah. Well, ketamine as a detaching.
As detaching.
And the detaching
And
effect of ketamine.
And so you're asking, will people be detached from the election
Yeah,
cycle?
I think it's a reference to some billionaires who indulge in that regularly and be divorced from the real world.
Okay.
I'm being as diplomatic as I can.
Yeah, but I'm sorry for like asking 7 follow-up questions. But are you talking about the general public, or are you talking about the billionaires?
I think Scott was talking about the billionaires and the disconnect between their lives, their experience, and what might be writ large the real economy for everybody else.
Yeah, I haven't. Yeah, sorry, I haven't heard that term, ketamine economy. That's a new one to me. But I think that we do see that. Like, if you are a billionaire, you can kind of design your own future. Like, I was at a conference this past weekend with a bunch of them, and it was, it's just a different life. It's just a different mindset. There's a quote on Twitter which is a little bit crass, but it's like being a billionaire is sort of like getting kicked in the head by a horse every day, because your life is so fundamentally different than what anybody else's is, because you can sort of purchase your way around all of the friction in everyday life. In terms of the election, are you talking about them like participating in the election, or?
Yeah, does the disconnect drive? Will there be a reckoning? Do you think there will be a
To
reckoning
the billionaires.
in terms
Oh,
of the
yes.
elections?
I see. Okay. Maybe. Yeah. I mean, that's something that seems to be bubbling up more and more, is like anti-rich sentiment. You see it in taxation policies. So I do think that'll be a big thing, is sort of the for lack of a better word, the eat the rich concepts. Yeah.
All right, last question over here. We're short on time,
Yes,
so just
Yeah, I see the clock there. I'll keep it quick. You talked both briefly about this dismissing of the University of Michigan sentiment study. What is causing that? Because we look at that every single time it comes out. And I make luxury goods, power sports equipment, a lot of toys for real rich people, and it's not jiving. They're spending, and then when we create a value product, they spend too. They find a way to buy their luxury goods wearing Costco jeans. How can we reconcile that to the University of Michigan sentiment?
Do you want to take one?
I mean, there's a good paper that I think that Fed researchers did recently that basically found a breakdown in the correlation of sentiment to spending after the 21-22 inflation hit. And so what you're registering now isn't so much people telling you, I don't like the economy because things are getting worse, I'm not going to spend. They're almost just registering their unhappiness with the big increase in the price level. And the fact that you're able to push along, to the extent you're able to push along price increases and people are accepting it, that's another surprise. I mean, as an economics reporter, I'm fascinated by this. People are accepting the price increases, but they hate doing it. And, you know, for the Fed, that's a little bit of a concern, I think.
Yeah, absolutely. Yeah.